Today we're going to talk about financial institutions and their role in American economic development, and I am going to be upfront here. This is not my strongest area in economic history. There are plenty of people who can give you huge dissertations about the role of finance and its effects on economic development in America and on business cycles, the financial crises. I am just not very strong at all this, so please bear with me through this, but I'm going to try at least make it a little bit fun. And the way that we're going to start off is just making sure you have the right idea of what a bank is. I think most people think of a bank like this, a giant place like Gringotts where fortunes are protected by dragons and it's just a place for you to store your money while, you go off and live the rich lifestyle. But that is not the purpose of banks. The banks are more like another scene from the wizarding world, and that is here in Fantastic Beasts and Where to Find Them, where you have what's his name, Kaminsky, whatever it is. I know it's the same thing as that penguin in Madagascar.
Close. Where does this aircraft go?
From the odd shape of this bagel, I'd say we're headed for Paris.
France? Forget it. Not with their tax laws.
And you've got Newt Scamander here, and he's got this idea of trying to start a bakery. He needs to get money to start that bakery. So he has this idea for business, and he wants to go get some money to fund it. That is how we should be thinking about banks. And so let me just go through a simple model of banking for you. And there are two types of people in this world. You have people with money, and then you have people with ideas. And the problem is these two people can't get to each other. Now, of course, there are people who have money and ideas, and they don't need this, so they're off somewhere, okay? That's fine. We're worried about the people who have money but no ideas, and the people who have ideas but no money. Now, if these people with ideas could get money, they would be able to create really productive things. Things will help grow our economy and things that could help them make money for themselves. Problem is they don't have that money. So everyone's sad in this world because the people with money, they don't know what to do with it. The people with ideas don't have any money to do them. So there needs to be something that brings these people together. And that's where banks come in. And the beautiful thing about banks is that you don't actually have to have these people get together. You have the people with money put that money into the bank. The bank then looks for people with ideas and lends money to those people. Those people use the money, they go execute on their ideas, they start their bakery, they start whatever business they have in mind, and then they've earned enough money to not only pay back that loan, they're able to pay it back with interest. That interest then goes to the people who lent that money in the first place, and that is the people who had the money but no ideas, right? They're getting interest on the money that they've deposited into the bank. And so everybody is happy at the end of this because the people with money are investing it and they're getting a return on their investment, so they're happy. The people with ideas have money to go get their ideas implemented. Everybody's happy in this world. This is great. This is what banks are for. Banks are about matching money from savers, people who have money, to productive opportunities with borrowers, okay? They're trying to match money. They're trying to match people on both sides of this. And you don't have to match it one-to-one. That's the thing, is that it's not just, okay, we're going to take the money from this specific investor and then bring it over to this specific borrower. It's the idea that we're going to create a pool of money, and that pooled money is going to go towards all these different investments, and then there will be a return on that investment at the end for those savers. Great thing. Matching money to opportunities. Basically, banks are like Tinder for money. They're all about matching up people, and they also seem to do a pretty good job making people miserable, just like Tinder does, I guess. So that is just kind of the basic model of banks that you should have in your mind, is this institution that matches money from savers to borrowers. I keep saying that over and over again, but that is really, it's called financial intermediation, right? They're intermediating, they're in the middle of this interaction where they're trying to get money from one party to another. And this is really needed. We also, think about if you don't have money. Think of you're one of the people with ideas and you're looking for people to borrow money from. Well, if you don't have banks, who do you borrow from? You might go to your parents or other family members, or you go to your friends, like neighbors type thing. But that means the only people with ideas who end up with success are the ones who have friends who have money or family who have money, which means that we really limit the opportunity for people with ideas to go execute on them. What we want is some way to get money to those people without requiring them to be connected to the people with that money. And that's called an impersonal source of credit or impersonal source of finance. And that's what banks provide. The bank gets to know me, but I don't have to be a relative. I don't have to be their best friend for me to get access to credit there. And that opens up so many more opportunities for me because it's not about who I already know. I promised you that we would get to Hamilton one more time, and here it is. Let's talk about the role of banks in Hamilton's financial plan. Now, banks were incredibly important to Hamilton's financial plan. He had this vision of a national bank. He wanted to mimic England. So England had the Bank of England, and it was there to help the government and provide credit to the government and to private sources, and it was a regulator of sorts. He wanted a similar thing in the United States. He wanted to have a bank that would aid with the collection of taxes, where tax revenues could be deposited, where there would be an easy way to work with a bank, and that was going to be this nationally chartered bank called the First Bank of the United States. He was a huge proponent of this, thought that this would be really needed for the financial system, but of course, Jefferson and Madison are against this, just as they always are. It's always Hamilton versus these guys trying to figure out what they're going to do. He wants to charter this national bank. This is actually brought up in the musical Hamilton in Cabinet Battle number 1, right? It talks about Hamilton's financial plan to establish a national bank and to assume state debts. Now, they don't really get into the whole banking part. They're more on assuming state debts in that rap. But yes, he wanted to do both of these things. He wanted to incorporate a national bank. I also mentioned this in that Hamilton State Capacity lecture. I said 3 things about his plans. He wanted discrimination, assumption, and incorporation were the 3 things that they were debating. We talked about discrimination and assumption in that lecture, and today we're talking about incorporation. That's what this bank is. So how would this First Bank of the United States work? Well, you would have all banks at this time are issuing currency. What would happen is I would go deposit my money into a bank, and they would write me a slip that says, this is how much money you have available to get from this bank. Well, I could go use that and give it to someone else and say, hey, here's this slip that you can use to go get money from that bank. Let's call it the Bank of Paulson. Okay, the Bank of Paulson wrote out, this is how much money is available here. Maybe they're they've got different banknotes, different denominations. So now you have that on claim at that bank. So you can go to other people and other banks and say, here you go. You have all a claim on deposits that are in the Bank of Paulson.
This is a Schrutbuck.
Well, the First Bank of the United States was going to do the same thing. They were going to be able to issue notes, but there was going to be a key feature of the notes from the First Bank of the United States. They would be accepted at face value to pay taxes. Now, let me explain what this means. When you get currency, when you get a dollar bill today, it says $1, and everybody knows that that's worth $1. It's accepted, and there's a long tradition behind that. There's a reason why we have that $1. But at the time, like the Bank of Paulson might write a bill that says $1 and give it to someone. Now, I go and give that to somebody else and say, here's $1 that you can go claim from the Bank of Paulson. Someone says, I don't know, Bank of Paulson, it's run by a shady guy. Not sure if I trust that guy to have that money by the time I get over there to claim it, right? It's going to be really hard for me to get all the way over there and claim it anytime soon. And by the time I get over there, he could be out of business. I don't know if I'm actually going to get that dollar if I accept it. And so there would be a discount. People would look at that bill and they would say, yes, that says $1 face value, but I think there's a 10% chance that he's going to fail by the time I get there. So I'm only going to count that as 90 cents.
What is the cash value of a Schrutbuck?
Excellent question, Pam. 1/100th of a cent.
So if you want to buy this thing that costs $1, you're gonna have to give me more than $1, so that way I can get it. You'd have to pay $1.11, of course, right? So then I take it at 90 cents and 90% of that value. and I then get that. So I'm taking on some risk by taking this bill from you. And to be compensated for that risk, I need to be able to be paid more than the value of the thing I'm giving up. So even though I'm giving up something worth $1, I have a 90% chance of going and getting $1.11, and then a 10% chance of getting nothing. Okay, you don't need to worry about the math behind all of this. You don't need to worry about the deep details of discount, but you should understand that banks would issue a currency, but that currency was not accepted at face value, except at the First Bank of the United States, where the government would accept it at face value. So now, all of a sudden, deposits at the First Bank of the United States are much more valuable than deposits at any other bank. This makes the First Bank of the United States have an incredible competitive advantage compared to other banks. Another thing that it could do, since it was a nationally chartered bank, it could have branches in all of the states. Most banks were constrained to the states that they were formed in. And so you could go deposit your stuff in one branch, and then you had opportunities at other branches. This just gave this First Bank of the United States a huge competitive advantage over other banks. So there are a lot of people that weren't thrilled that the First Bank of the United States, which is going to be in cahoots with the government, was going to have a huge competitive role. So, people are already skeptical of what this bank can do. But then Jefferson and Madison bring up this great point. Does the government even have the constitutional right to establish a bank? Nowhere in the Constitution does it say, and the federal government shall create banks when it needs to, right? It does not say that. So Jefferson and Madison are arguing, nope. No, that we do not have constitutional authority to establish this bank. And Hamilton looks at it and he's like, yeah, well, this is a hard case. Where can I find my argument for this? Hamilton looks at this and he's like, no, the Constitution does not give us the right to make a bank. It doesn't explicitly say that, but it does say that we're allowed to collect taxes. And we cannot collect taxes efficiently unless we set up this bank. Without this bank, it's just going to be so hard for us to collect taxes. There's no way we're going to be able to accomplish this. So as long as we're doing something that the Constitution does explicitly tell us to do, then yeah, sure, it's going to be legal. And this gets to be called implied powers, okay? It implies that we're able to do this. The ends justify the means is his argument, okay? Implied powers says, well, we don't have to have everything outlined. As long as we have the thing that we need to do and we can prove that this is necessary to accomplish that thing, then we're allowed to do it. And this has been used ever since Hamilton came up with this argument to justify lots of things. So the draft is one. So when we're in times of desperate war, often the government will use a draft where they conscript people into the army or into the military. And the idea is, the Constitution does not say that the government has the right to draft people into the army, but it does say that the government is supposed to protect the people from foreign threats. So if the only way to protect people from foreign threats is to then draft people into the military, then the Constitution implies that we can do it. Now you can see that this is kind of a slippery slope argument where as long as you can justify what you need to do with what you want to do, then you can say, oh yeah, the Constitution allows us to do this. So this is, a legal argument that's got a long history. I don't even know the full contentions behind it, but you need to understand that that's how Hamilton was able to win on getting a national bank, was by convincing Washington that yes, we can do this. Otherwise, we're not going to be able to do taxes. So again, Hamilton wins again on this. He gets the national bank, and the first bank of the United States is chartered. The bank provided lots of things for the economy. It provided a public and private source of credit, right? So people could deposit their money in the First Bank of the United States, and then the First Bank of the United States would make loans. Right? It's tender for money. It's matching up money from savers to opportunities with borrowers. That's the role of the bank. And so it was doing that both in the private sector with just regular individuals and in the public sector. If the government needed to borrow money for a project, it could go to the First Bank of the United States and it could get a loan. It was printing that currency, right? Not the currency that we think of, but it's printing bank notes. People could go use those bank notes as currency in other places. It also used some regulatory features. So the First Bank of the United States essentially could regulate all of the other banks in the economy. And it had a few powers. It wasn't explicit. It's kind of hard how this all balances out. What you have is this bank was so big because of all the deposits from the government that it had market power. It had the ability to influence the other banks in the system. If a bank looked untrustworthy, the Bank of Paulson, we think it's going to fail. Well, all those bills from the Bank of Paulson that make it into the First Bank of the United States, they can go and say, hey, you need to give us gold, you need to give us silver, you need to give us the specie backing this because we don't trust you to allow this to fail. And so since the First Bank of the United States could call out other banks, it kept them in check. They realized that they needed to be a little bit more careful as they're issuing currencies and as they're issuing loans, so that way they didn't fail. Essentially, the First Bank of the United States was supposed to be the Federal Reserve. Hamilton's idea was, here's the central bank. It's going to be able to do all these things to help the credit market flow. It's going to help regulate banks. And it was supposed to be the Federal Reserve. But people start becoming skeptical of it, just like people are skeptical of the Federal Reserve today. So in 1811, the charter for this bank was up for renewal. So there was a charter that said, this is the terms under which this bank is allowed to function, and that charter was given by the government. Well, in 1811, it's up for renewal, and it fails by one vote. And it comes really down to the line, as much down to the line as you can. It fails, and so this bank goes out of business. Well, after 1811, there's a war, there's lots of things going on. There becomes some financial instability. There's there's growth in the number of banks. Just all these things are happening. And people are realizing, oh, we've got a little bit more financial instability right now. Now, it might not be because the bank is missing, but it is contributing to it. And so in 1816, they decide to bring up the bank again. They call it the Second Bank of the United States. They recharter it and they say, okay, we liked this thing, let's keep it going. But then you have just like more opposition to it. People who, like the Fed today, don't like the idea that there is a major government force in the financial system. They don't like the concentrated market power. There's just all these worries about that bank. And Andrew Jackson especially hated the Second Bank of the United States. And one of his key platforms was, I am going to get rid of this bank. And so when he was president, the writing was on the wall and this bank just starts slipping into nothingness until finally in 1836, when its charter is up for renewal, it just fails. This bank is gone. And so we had something like a central bank up until 1836 with a small gap. And I guess, the last couple of years of that bank, it wasn't really functioning. And then we don't have a central bank until we get the Federal Reserve in the early 1900s. And that's going to be really important because we're going to have a lot of financial crises. We're not going to go over all the financial crises. We'll go over the Panic of 1907, how that leads to the Federal Reserve. But like the Federal Reserve itself and this idea of central banking in America is actually like a pretty recent idea. We've only had it for 100 years. By the time you get to the Great Depression, we didn't have that much experience. I'm getting way ahead of myself. We'll talk about all this later on in the semester. Just the idea that we've learned a lot about central banking lately. That's probably one of the greatest things we've learned in economics over the past couple of decades. But let's talk a little bit about bank chartering and what comes from bank chartering. So charters were things issued by the government that gave you the right to go to function. So you get a charter for a bank. So we had like the First Bank of the United States and the Second Bank of the United States, both were chartered. But you would also get charters for like corporations. If you wanted to start a bigger business that had certain rights or privileges, you would need to get a charter from the government. The government would vote on whether you were allowed to do this business or whether you were allowed to run a bank. Now, the idea is we're giving you special powers when you're in this charter. There are things that you're going to be able to do, and so we want to keep a close eye on this. But the problem is you get people who start abusing the fact that the government gets to decide who operates in business and who doesn't. And a great example of this comes from New York, where there are limited charters. There are banks that want to enter, but there are only a few charters that are allowed to come in. If there are only a few people who are allowed to operate a bank, that means those banks are going to have incredible power. They're basically monopolies. If you have monopolies available, there are people who really want to make sure they have those monopolies, and so they start bribing government officials to make sure that they can have those charters. They want to be able to be like, I'm the banking guy, and I'm willing to bribe officials to make sure that I get that bank. Well, so you get this rampant corruption in New York over starting banks, and it becomes this huge problem. Some people were inspired to go through some reform. They were like, oh, we can't have this going on. Let's instead require 2/3 of Congress, their state legislature, to pass this for, that way they're not bribing off a few people and just getting it through. But really what this ended up doing is like, oh, this just means I need to bribe like more people to get this thing, and just increase the stakes, and bribes got even higher. Huge corruption problem, right? Like, how do you deal with this? Now, Martin Van Buren is in the New York government at this time, and he wants to improve this situation, but not by that much, okay? He wants to have more banks, and he wants to protect the public, so that way it's not just willy-nilly banks that are scamming the public. But he also really likes the political control that comes from controlling how many banks there are. So there's this threefold problem. We want more banks, we want to protect the public, but we also want political control because we can use these banks to reward our political party and to crush the enemy. So Van Buren pushes through the Safety Fund Act. The Safety Fund Act is basically deposit insurance. It was this idea that we're going to charter a lot more banks, but new banks need to go put money into a pot. There's going to be a pot of money. All these new banks are going to have money in there. And then if one of these banks fails, the money from that pot is going to be used to cover the failed deposits. So if I had deposited my money into this bank and the bank goes out of business, I now have a place to go to make sure that I can be protected. This is a form of insurance for depositors. I have much more confidence in these banks when I go put my money there. And if these banks fail, the public's protected, right? I'm protected. So we're accomplishing two of these things. We're increasing the number of banks while also making sure the public is protected, right? But what about the political angle? Is Van Buren getting all three of the things that he wants? Yes, even though we're increasing the number of banks, Van Buren is still limiting the number of banks in the state. So yes, you can still extract some what we call rents. We can get bribes. We can promote our political party by controlling the bank still. Well, soon after the Safety Fund Act, this all comes crumbling down. There's this man named William Morgan who was in the Masons. Yes, I believe he was in the Masons. There's the Freemasons, a secret society that had lots of members throughout the United States. He was in there, and then he comes out and threatens to expose the Masons' secrets, right? Like, oh, here are the things that are going to happen. He gets arrested, and then, he's put in jail, but then quickly released, and then he disappears. No one hears from him again. What happened to this guy that was threatening to reveal everything about the Masons? And the thing is, this is not some, super, conspiratorial Illuminati confirmed type deal. This was legitimately the Masons had control in the government. They had all these members, and they were, I don't know, how to say the Masons were manipulating the government, but essentially people were using the Mason organization to move politically, and they were very, very interconnected with this whole banking system. And people realized, oh my goodness, we've got Masons controlling the government. We need more people control of this. And so there's this huge movement to get this kind of elite control over the government gone. And they push through these big reforms, and what you get is the elimination of banking charters. The government no longer determines whether you're allowed to bank or not. You get to free banking. The idea is anybody who wants to start a bank can start a bank.
We're opening a free bank to put them out of business.
Let's go.
Yeah.
And you get to this era of wildcat banking. Where people just start up banks like crazy, and there's kind of mixed evidence on what this did. Some of the great things it did was it increased the number of banks, and it increased the amount of capital. There were a lot more people who could invest. There are a lot more people, if you wanted to get a loan and this bank turned you down, now there's competition and you can go to another bank. These are good things. We want those kind of things. But there's also some evidence that it increased financial instability. It seems like it was concentrated in just a few areas, like maybe New York, Michigan. There are other states that did better, like Louisiana. And so you get like this free entry, you get more inclusive institutions where anybody is allowed to participate, and you get like a trade-off. You get some good things, but of course you get some bad things. So, again, this is a part where my lack of understanding about the financial system really shines through, because I wish I could just dive in and go and tell you all the great stories about what was happening at this time. But the idea is, we moved from an exclusive institution where only a few people were allowed to participate to an inclusive institution, and it seems like it did good things for the economy. Now, how do banks help the economy? Well, basically the idea is these people with ideas now have money to go and help the economy. Now, I mean, they're not trying to help the economy, right? They're just trying to make money on their ideas. But now they can actually do that. Before they were restricted, and now the more banks there are, the more competition there is. These people can actually go out there and do this. And one way we can test this is just compare what happened to the United States to other economies. We're going to compare it to Mexico and Brazil, who had very different financial experiences in their banking sector. So in Mexico, there were no banks in Mexico until 1864. Now think about this. Like, the Spanish Empire came over to Mexico before the British got to what would become the United States, right? So the colony of Mexico and the country of Mexico today is older than what we're seeing in the United States, and yet they did not have any banks until 1864. That doesn't mean that there wasn't a market for credit, right? There's always a market for credit, whether there were banks or not. But the problem is it's like more like back alley stuff where people are paying exorbitant interest rates just to get a little bit of credit. By 1911, there were only 10 banks that were allowed to lend for more than a year. And only 2 banks accounted for 75% of deposits, right? Very concentrated banking. Only a few banks are operating. It is very different. It's not like the United States where banks are just spreading all over the place because anybody who wants to start a bank can start a bank. It's just very few banks. You don't have opportunity to go to this impersonal source of credit. Now, why did Mexico have such a different experience than the United States? There are 3 main reasons. Mexico had a smaller economy and it had very high inequality. And what do we know about high inequality? Well, it leads to exclusive institutions, right? And so you get people who, you're not setting up banks for the rest of the people. You also had property rights issues where it was very hard to, if you lent your money, you might not get it back. And so people were not trusting these banks. And there was a really harsh regulatory environment. These are these laws that say you can only operate a bank if you meet all of these requirements. And because it was so burdensome, you couldn't really start up a bank. Okay, so we're having small economy, high inequality. High inequality leads to not much banking. Brazil is pretty similar. In 1888, only 7 out of 20 Brazilian states had banks in them. Half of all deposits were located in Rio de Janeiro. And the reason is for similar causes as Mexico. It was a small economy with high inequality, not really well-defined property rights, and a really cruel regulatory environment. Brazil ends up opening a little bit sooner. In 1889, the Brazilian monarchy falls, and in 1890, you have the encilhamento, which is this big reform at trying to open up the economy. There was this huge burst of economic activity for a few years, and then it crashed. So in 1891, you had 68 banks, much more than you had in Mexico. But then by the early 1900s, it had been whittled down again because of this huge crash. But still by 1918, there were 51. So Brazil had a little bit more open of a banking experience than Mexico did. So what we might expect is, we could rank the United States as high on financial capacity. You had a lot of banks available. Brazil, much lower, but still better than Mexico. Well, to look at how these banks affect industrialization, let's look at cotton textiles. And cotton textiles, there's a huge advantage to looking at this. Cotton textiles are like making clothes, right? And the reason why this is a good thing to look at is because there were basically no barriers to entry. There were no patents that prevented you from getting in. The minimum efficient scale was very small, so you didn't need like a huge factory to do this. You just needed like a small factory. So you could actually get a decent sized loan, something that's available to a lot of people, and you could just start up your own cotton textile factory. In fact, that was the only barrier to starting, was whether you could get money to buy the equipment you needed. So what do you think is going to be different on cotton textiles between the United States, Brazil, and Mexico? Well, we can look at cotton textile concentration, and where that is, like, how much of the activity in the cotton textile industry is concentrated among the top firms. And what we might expect is, if you have a lot of cotton textile firms, you have a lot of competition, then you're not going to have as much concentration. But if you only have a few cotton textile firms, of course, you're going to have much more concentration. Now, if you have a lot of banks and you have people who can just start cotton textile firms when they want, well, then you're going to see less concentration. You're going to see lots of competition. And if you don't have that many banks, if capital is not available for most people, then you're going to see a lot of concentration. So what we might expect is that the United States has a low concentration, and Mexico and Brazil have much higher concentration. And we see that in this table. You can see that the United States, only about 10% of textile production was focused in the top firms. Well, if we go over to Brazil and Mexico, you're seeing 15 to 30% of cotton textile production is concentrated in these firms. So it looks like our banking system helped the United States industrialize, and it looks like it helps the United States develop. So the banking system, while it gets a lot of a hard time, it actually was very beneficial to economic development. One of the things I really like is we had a point where there were highly exclusive institutions. Banking was really closed off, but it was broken, and we figured out how to fix it. And we see that a lot. There's a pattern where the United States has done a pretty good job that when they had broken institutions, exclusive institutions, and they move towards more inclusive institutions. We had that with slavery, we had that with banking. We're gonna see that with the civil rights movement, with women in the labor force. We're gonna see that we do a good job of fixing those broken things.